Hey everyone, so I'm Matt Walsh. I'm the co-founder of Castle Island Ventures. We're an early stage seed-focused venture fund. We're investing in permissionless blockchain infrastructure companies. So the title of this panel is The Future of Institutional Adoption of Blockchain and Crypto Assets. We're going to focus mainly on the crypto assets here. I think we can all agree that private blockchains are not a thing other than in IBM commercials and innovation labs. And really don't have much of a future. But with that, I would love to just pass it off to the panelists to introduce themselves. I think we have a great panel. We have three people who are coming at the industry from different perspectives. And there's certainly a lot of infrastructure here to build in order to really push this forward in institutional context. So why don't we start with some introductions?
We'll find out. Does this work? It sounds like it. So I'm Tim Rice. I'm the CEO of Coinmetrics. Joined Coinmetrics November 1st. I have a long history in financial information, working for most of the traditional capital markets data vendors, Thomson Reuters, Interactive Data, places like that, and kind of monitoring the transition between getting crypto asset information exposed to institutions so that they can understand how they should invest in the marketplace.
Does that work? Yep. No? Yeah? Great. I'm Joe Lallouz. I'm the co-founder and CEO of Bison I have a background in startups, building startups for the last 15 years. Built a bunch of venture-backed startups. Bison Trails is a company that's focused on building infrastructure specifically for participation in next-generation blockchains.
Great. You guys can hear me? Okay. So I'm Sousa. I lead operations at FalconX. It's a firm founded by HBS students. We get accused of not jumping into crypto right away, but we eventually do, I promise you. And we're a digital asset brokerage that allows institutional investors to set up a single account, plug into dozens of liquidity venues, and find the best possible price for the trade that they want to execute.
That's great. So why don't we hop in here with Tim. So Tim, you come from a background in traditional market data, having worked at Thomson Reuters and TradeWeb. What is the current state of affairs for the crypto asset industry as it relates to market data and network data?
Yeah, so it's interesting. I've worked in back office operations and fund accounting and kind of tracking these assets once they're in the marketplace. And today, institutions that you talk to, well, maybe not now, but 6 months ago, assumed reference data was something that existed behind each of these projects, assumed they had access to understand the fundamental data coming from the blockchains, and then were completely stymied to understand that you have to go to 45 different venues in order to get your market data, and then within those venues, you have to have some idea of whether they're reputable, how big are the trades that are going across those exchanges, and how do you aggregate that? So what that presented in general was this massive infrastructure problem on the back end. So for years, you went to New York for IBM. It was simple. We aggregated in New York. We aggregated 230 exchanges globally at Thomson Reuters. That provided a massive service layer for big banks and trading institutions. And they don't necessarily want to get involved in this going forward. We have 200 APIs we're connected to on the back end. We're having to run multiple redundant data factories. It's just becoming quite a mess. And then you get into the aspect of where are you getting quality data from? Are you seeing large enough trades to actually make an institutional statement on whether that's a good trade, whether they're the right size? And then simple things that we saw in end-of-day valuation or P&L for anything is basically today, if I'm a fund and I basically say to my fund administrator, well, just take the coin market cap close at 4 o'clock yesterday afternoon, or take coin market cap's price at 4 o'clock yesterday afternoon. There's no transparency into what that price is made up of. You don't know where it came from. It's a snapshot. Is there any way to audit that going forward? And so, there's a lot of standardization and framework that need to be set up in order to take that liability away. So those pricing committees at those funds and family offices and institutions is bearing a lot of liability for coming up and just saying, okay, this is what we're going to choose from. Or I've heard some institutions are basically saying, hey, wait a minute, I can create let you customize or concierge your own closing price. So now you're basically giving the poacher the responsibility of being the gamekeeper, where you're saying, hey, create your algorithm, we'll figure out which of these exchanges you trade with, and that will be where we come up with your closing price from. So there's a lot of need for standards that are going to help with fiduciary responsibility to bring institutions into the marketplace. But the aggregation frameworks are quite broad, and kind of building those infrastructures to institutional grade sophistication where you've got security audit compliance, you've got systems compliance, you're running hot, fully redundant data factories, is something that the current marketplaces resembles for market data a lot of a business to consumer play, where it's like, I can plug into this exchange for free and provide this data, and here's my cool website, come here and we'll give you the top 10. So I think there's a lot of upgrades that still need to go on across the industry.
That's great. Well, I want to hop over to Anna to talk about the trading side of this and some of the challenges there. But before we do, why don't we hop over to our fourth panelist, and can you just introduce yourself and maybe tell us what you're up to?
Yeah, sure. Okay, so hey guys, how's it going? Incredibly sorry for coming a little bit late. The blockchain is just too interesting. I was looking at the coin market cap ups and downs, so I apologize. But in any case, I'm very excited to be here. My name is Stefan Chin. I run a hedge fund called Virgil Capital. We're a high-frequency trading firm in crypto. We currently trade over around 40 different exchanges or so, and around 6 different countries. But long story short, I was thinking the quant side could be represented here a little bit, and that's what I'll be talking about today. So.
Thank you. So Anna, why don't we hop over to you? And obviously the trading environment in this ecosystem right now is incredibly nascent. What problem is FalconX trying to solve? And tell us a little bit more about the state of the market for trading infrastructure.
Sure. So if you guys trade in crypto today and you came from a traditional capital markets background, you'll know that the trading infrastructure is very primitive. Right, so that was one of our key insights, especially as retail receded a little bit and institutional interest came in. People are coming in and saying, like, where's the prime broker that everyone works with? And we're like, there is no. There's some up and coming companies, but there is no kind of infrastructure where you can reliably come in, execute trades for different types of assets in different types of volumes, and do it without hassle. So that's the problem that we're solving for primarily. Crypto trading has specific problems to the asset class that don't really happen as much with traditional assets. Can you guys hear me a little bit better? So one of the big problems is with wash trading, right? If you go to blockchaintransparency.org, they do a great job and a great service to the community, just listing out the exchanges and the level of wash trading that happens with each one, or the way that they show it is the level of actual trading that's happening in each exchange. And it's incredible the numbers that you see. A lot of exchanges at 1%. So how can you reliably execute a strategy, especially a high frequency strategy, with exchanges where the actual volume is only 1%? So one of the big insights that we've had and that we've been able to act on really well is building machine learning models that can wash out the wash trading so that you are actually trading on real volume. Our founding engineers from TensorFlow, he was actually a founding member of TensorFlow, which is Google's computational framework for machine learning models. And we've been able to build a system where we can estimate the price slippage, we can basically take out the wash trade so that the traders coming in know that they're actually executing on real order books. So that it has been a game changer. Our clients are telling us, like, I used to take all this counterparty risk, I used to be really worried about leaving funds overnight in certain exchanges. But with the system that we've put together, like, it eliminates a lot of that.
That's great. And I know, Tim, you've looked at the wash trading, and this presents a big problem for data capture, particularly for funds that are trying to market their books.
Yeah, I mean, it's super interesting what you guys are discovering, and we're doing the same thing. We're trying to, for reference rate calculation, we're trying to actually create an infrastructure that whitelists by asset, by exchange, what data should be included in a reference rate, and we're having to do a lot of job filtering that same kind of information.
So Anna, you mentioned the trading, the exchanges, and I'm curious if we can hop over to Stefan and just talk a little bit about what you're seeing from the perspective of an asset allocator in terms of the exchanges that you're dealing with, what challenges you're facing from an infrastructure perspective.
Yeah, it's a really good question, and thanks for asking. So first of all, to your point about wash trading, that's incredibly true. As we trade over many, many different exchanges, and just some more context, we're actually a pure crypto fiat arbitrage platform, so we actually only trade on fiat on-ramped exchanges. Essentially, what we've been seeing is that it's not actually exchanges themselves that are wash traded, because if you look at the top 10 coins, say, or so, most of them are relatively not actually that much wash traded compared to something from like the bottom 10 to infinity, right? So we were doing a bit of analysis of the data on like these bottom 10 coins, and it turns out that the coins themselves are wash traded regardless of what exchange they're on, right? So for that reason, if you're looking at which exchanges to trade on, for example, the best thing to look at is not actually, the exchange itself, but potentially which coins they list, or like how they list their coins and things like that. So that's a really important thing to note. From an asset allocation perspective and how we trade on exchanges, to be honest, we currently actually store the large majority of our assets on exchanges, just because that's the fastest way to trade right now. The market's actually quite liquid compared to something like a year ago. So if you don't have your assets on exchanges, it's actually quite difficult to capture a lot of the opportunities and the inefficiencies you might see on the exchanges. So for that reason, it's actually sometimes necessary, depending on your strategy. We're a high frequency strategy. So, in order to capture these opportunities more quickly, we definitely have to keep them on exchanges. Let's say we keep them on a cold wallet though, right? You'd have to send Bitcoin from the cold wallet to the exchange. It could take like an hour or a couple of hours, depending on network congestion. It takes too long, right? So for that reason, one of the things that you see in blockchain and crypto exchanges versus traditional exchanges is that you can't really trust them unless you know them, right? It means a lot of the counterparty DD you do has to be something relationship driven, for example, or it's difficult to assume or rely on these infrastructures that you might otherwise see in traditional markets, like settlement or even delivery of the coins that you paid for. Do you know what I mean? And things like that. So long story short is, for that reason, there's a couple of different things. The first is when you look at whether or not you want to develop a high frequency trading strategy, you see whether or not the coin itself that you want to trade on is a viable coin to trade, because, that's if it's wash traded or not, basically, right? Then the second thing is whether or not the exchange itself is trustworthy enough in terms of, all the different parts of, trading, like issuance, settlement, delivery, things like this, right? And then that's just the first step. Then you've got to decide, whether or not that exchange is liquid enough, for example, or has enough volume to actually trade the size that you want to trade. So there's a lot of these different aspects that go into determining whether or not to deploy a strategy onto an exchange, just to be clear. And compared to the traditional markets, and I could go on for a while, and I'm not going to. But long story short, there's a lot to consider, and it's very unique to the crypto space, I would say. Yeah.
So Joe, I want to flip it over to you and talk. We've talked a little bit about the front office here. I want to pop over to some of the back office and specifically asset servicing. So when I look at your business at Bison Trails, and would love to hear you tell the audience a little bit more about it. When I think about something like staking, it reminds me a little bit of securities lending in the traditional space. So I'm wondering if you could just talk a little bit about the services that you provide at Bison Trails and where that fits into this whole institutional paradigm.
Sure. Is this working?
Yep.
Okay. So one of the things I'm actually hearing is, it's funny, from the panel and actually from the previous panel as well, I've been hearing a tremendous amount of folks talking about kind of like the end user experience, and then also very specific types of experiences that various companies are building. But there's a resounding sort of commentary that keeps coming up, which is that like the infrastructure is super hard, you have to trust it, you have to develop these trust relationships. The data is really hard to find, or it needs to be aggregated across a whole bunch of different sources. And so we're still kind of in stealth mode, our company. But the entire premise for what we're trying to do is to make it extremely simple for institutions, large asset holders, crypto funds, hedge funds, exchanges, custodians to participate in a ton of different public blockchains. And when I say participate, I mean actually deploy and run secure, transparent, self-healing, highly available infrastructure on those networks. And the reason why they want to be able to do this is because they want to be able to develop those trust relationships with those exchanges except most of the time they actually want to run some of that in-house themselves. They want to be able to double check it. They want to be able to understand what's happening in the network without having to necessarily trust a third party to be able to do that. And so that was the premise for founding this company. Funny enough, I'm not a trader. I'm not an HFT trader. I've never run an HFT fund. But I did actually get involved in this because I started trading crypto assets, and I started running HFT strategies on centralized and decentralized exchanges. Hint, no liquidity, don't do it. But we got killed. I mean, we eventually got killed because we're not good at it. But what we did do was realize to be able to do this super, super well, we needed to deeply understand the networks themselves, how transactions were being processed, how the chains were set up. And to do that, we ended up setting up all of our own infrastructure. And so we then helped a bunch of large asset holders do that, and a few large institutions do that, and realized there's actually a huge opportunity here. So that's what we've been doing. As it relates to staking in particular, one of the ways that you can participate in what we're calling next generation blockchain platforms is by staking. And I don't know if I want to get into a whole broad discussion as to what staking is and why it's valuable or why it's maybe not valuable. But the idea is that it is one form of participation in a network. And what we're trying to do is make it super, super simple for folks to participate in those networks, whether it's staking, whether it's governance, whether it's block signing, whether it's transacting, whether it's relaying, whether it's even to some extent market making. We haven't really been focused on it right now, but that's what we've been doing.
That's super interesting. So if you look 5 years out, what do you think that this looks like from the perspective of, say, a crypto fund or an institution that holds these assets in terms of what their participation on the networks would look like?
Yeah, I think it really depends on the type of fund. And we've been working with a few different types of funds. So there's some folks that are highly, highly focused on liquidity and moving assets really quickly and trading assets regularly. Like an HFT fund is looking for arbitrage opportunities that are in microseconds, right? Staking is probably not that relevant to them, except when you start to see outsized opportunities or arbitrage opportunities in lending, right? So you can actually stake your assets and see a better yield than if you were necessarily trading those assets very quickly. And so I don't actually know. I can't tell the future. I don't know what that's going to look like over the next 5 to 10 years. I do imagine that over time, the amount of money that can be made, in particular in that space, is going to compress, and it's going to look a lot more like a traditional lending ecosystem. But at least right now, folks are doing that and making 70, 80% ROI, which is crazy.
So maybe to switch gears a little bit, coming from the perspective of having worked at Fidelity, obviously custody is a big challenge in this industry. And also the liquidity environment is just very immature, particularly with the over-the-counter market. So maybe just switch over to Stefan, and could you talk a little bit about what that OTC environment looks like, how you think about OTC transactions versus executing on exchanges, and maybe where you see that OTC market going over the next few years?
Yeah, thanks very much. So the question is around the OTC ecosystem in crypto currently. And there's many different aspects of this, and I'll talk a little bit about how it maybe compares to traditional asset classes. But long story short, if we're comparing apples to apples, it's pretty underdeveloped, right? There's two different parts of the OTC market currently. There's the OTC markets trading desks that are standalone, that don't have any additional businesses attached to them. And then there are things like OTC exchanges. So some exchanges might offer their own OTC desks to large volume traders and things like that, for example. So long story short, if I package them into one bundle, currently the main method of doing OTC is literally through things like Telegram or WhatsApp or text, right? If you compare that to something like traditional brokerage services in traditional asset classes, a lot of it may be done over the phone, for example, and it's much quicker. You can trust the broker, so their settlement time might be even something like T+1 or T+2. In this particular instance with OTC, you might have to wait for the bank to clear your fiat funds before you get the crypto delivered. And that could take 5 to 7 business days. And if your bank doesn't like you, it could take a bit longer, for example. So there's a lot of complexity here, and it's actually a lot related to the delay. caused by, say, different brokerages in terms of compliance and KYC and things like that. But that's just one aspect of the crypto ecosystem. I think another big thing to note is that the OTC trading volume, surprisingly, would account for a large amount of volume that's off the books, and a lot of people don't realize that. We were talking about data just then, and data is incredibly hard to find. But if you are a trader on an OTC desk and you say you've built good relationships with them, you can often see, and you can also get some of this information, for example, on how trustworthy that OTC desk might be, or like what kind of signals they're getting and things like that. So that might inform some of your trading strategies, for example, and also which OTC desk you choose to trade on, right? And a lot of this market is very authentically driven just because there aren't a lot of strict policies in place compared to, say, traditional brokerage models. The fact that it's global as well, I mean, it's difficult to standardize things, because there are different compliance requirements everywhere, So you just, a lot of the time, you choose the one that suits your particular niche, right? I could go on, but I guess that I'll stop there.
No, that's great. And I want to build on the point around data. And so we mentioned a lot around market data earlier, Tim, and MVIS is pursuing an index reference rate for an ETF filing that relies on OTC pricing. The thought process being that spot market surveillance sharing agreements between exchanges are not in place yet. Maybe we'll see that with ErisX and Bakkt and some of the more robust institutional efforts coming on board the next few years. How do you think about the OTC market right now as it relates to maybe analogies for other markets? And where are we with the overall maturity of that market?
Yeah, I've been fortunate enough to be around long enough in the real OTC market where the broker-dealers step in and create electronic platforms, or we did voice brokerage years ago. And, I kind of look at the crypto market and what we call exchanges are retail brokers. They're not classic centralized exchanges as we used to have. And so, the exchanges that have OTC desks are just classic, re-enabling of something that's happened before, where a broker-dealer comes up with a desk and has an exchange. From a data transparency perspective, we're needing to do more to kind of drive into that data and understand how it's aggregated. Is it aggregated electronically? As you mentioned, the Skype trading, the Telegram trading, that's just not useful. I mean, the way we deployed at several companies I've worked for is we would literally read Bloomberg messages of bids and offers coming across the network, and we decode those into a network data feed that allowed us to enable, better transparency. So, I think the problem that we're facing is as we onboard real institutions, what is going to be their messaging framework? Are we going to have to go back to a Bloomberg messaging framework because that's accepted path, and then will we deploy some type of technology to read those? And then how can we actually create that into an index? I mean, OTC desks can drive flow to their trading platforms by delivery of their data out to the marketplace to see that.
That's great. So I want to open it up to questions in a minute here, but before I do, I'd love to just go through the panelists here and talk about maybe what you're most excited about over the next year in this space. So maybe, Anna, why don't we start with you? And what are you excited about? What levels of infrastructure are you keeping an eye on?
I'm really excited about solving this problem with getting better data out to the market, and especially to the institutional traders. I think that there's a lot of talent coming into the space when it comes to institutional trading, but because of the state of the infrastructure, right, and the fact that you have to be so reliant on relationships, like you have to meet folks in person and understand what it is that they're doing, understand what pressures they're facing, that the barrier to entry for most institutional traders, most funds, is still very high. So when we solve the data problem, when we can have reliable systems in place, those barriers are going to come down, and then you're going to see true institutional flows. A lot of people talk about, sort of traders are on the sidelines because of the regulatory risk and so forth. I think if you take a look at the history of Wall Street, like regulatory risk has never been one of the reasons that have kept traders on the sideline. I think that people are aware of the risks, and if they have enough appetite, they'll sort of find a way to mitigate it, right, and to deal with it. But that's what I would say. I'm most excited about dropping the barriers to entry for funds.
That's great. Joe?
Man, I love this question. I would say the thing that's most exciting, well, so two things. I don't want to steal from other folks, but two really quick things. One is that I truly believe we are at like day zero as far as adoption is concerned from large institutions, capital. You can look at like capital flow in, it's like basically nothing. I think a previous panel, Richard was talking about like, someone taking out a $3 million loan and that person's crazy. And I'm like, in my head, I'm thinking like, that is literally nothing. It's like a tiny amount of money in like the grand scheme of things. So I'm super excited about like large scale institutional adoption, that we're not even close to that yet. And then I'm also really excited about like 10 or 12 new projects that are launching over the next 6 to 18 months, that I think are going to really shake things up.
So I think, Lex Solkin from Autonomous gave a talk in London, and he talked about the fact that there's $87 trillion of investable wealth in the United States, and if we can get 10% of that into crypto, so I'm pretty excited to kind of support getting 5% of that into crypto, and from there, you all can take it over from there. And
Yeah, that's interesting. I think we all hope that as well. So, but I'm gonna get a lot of eggs thrown at me for saying this. But actually, one of the things I'm most excited about is actually regulation. And I know that everyone here, is like, oh, the SEC is like cracking down on all these cool crypto startups and things like that. Coming from the trading perspective, right? A lot of what I deal with is compliance and regulation, right? Especially trying to figure out which is the most trustworthy exchange and things like that. I'm glad to say that there is a trend moving towards things like self-regulation, which essentially means standardization, which makes it easier for people like me to make the markets more liquid and more efficient and actually make people feel safer, to be honest with you. So in my opinion, I do believe that, the adoption of certain policies, for example, and self-regulation by many of the current players in this space will lead to, a lot more institutional capital coming in and therefore more liquid and more fun markets to play around with, right? But long story short, I got no eggs thrown at me for saying that, but I am very excited. Yeah.
Can I so on the regulation side, I think regulation is important for the industry. And coming from the data perspective, I can tell you from firsthand experience, having just replied to 2 SEC's requests for information, there were only 2 crypto vendors who applied.
Not subpoenas, let's just be clear.
What?
Not subpoenas.
No, not subpoenas. No, these were requests for product information. The amount of vendor response to that was 3 companies. Everything else, so I think there's a lot of rhetoric going on at the regulatory level, and they're starting to try and figure out how to dive into the data side of things. So as much as I would like to be the company that gets a lot of this business, if the regulators are looking for deep data, let's get it to them, because the beauty of what's on network data and the on-chain data, if we can bring that to the other levels, this market will come along and they'll have no problem getting out of it what they need to get out of it. Sorry.
So with that, I'd love to open it up to questions. We have a few minutes left.
Can I ask you a question?
You can ask a question. Go ahead. 2? Is that what you said? All right, go ahead.
Okay. My first question is for Anna. So I know you mentioned that FalconX is an institutional grade broker, right? So I wanted to ask you to clarify a little bit about what you mean by broker, because to me, a broker provides, market access, liquidity, and also trade execution services. So, do you provide all of 3, and do you already have a plan to apply for SEC or FINRA license for that?
Can you repeat the question, Anna?
Yeah, so you're asking about what services we provide, and then there's a part about regulation, licensing. Okay. So I'll start there. So we are, I should have mentioned as well that we're in stealth mode, and we've been with the product.
You guys are doing a good job with stealth, both of you,
Exactly.
speaking on panels.
The stealthy part of the panel. So we've been onboarding clients in cohorts to test out our product, right? And we do offer trade execution. So a lot of prime brokers, if you guys are familiar with the space in traditional asset class, they offer a range of services, right? Trade execution being a primary one, lending, custody, and so forth, right? So we offer trade execution with now for sort of clients who are not in our beta cohort through an OTC desk, right? Where we price guarantee based on the best execution engine that we have in the back, right? So that's how it's a way for folks who don't know us, who haven't been formally onboarded into the beta tested out. We are partnering with a custodian to offer custody in a way that makes sense. To Stefan's point, it's very difficult to, like see an opportunity and then wait 2 to 24 hours to get the funds out. So we're working with custodians who are going to allow you to trade while your while your funds are still in cold custody, and then just settle when it makes sense, right? For the end of the day, when things actually change hands. And we're also looking into establishing lending facilities and enabling margin trading and so forth. But to be honest with you, it's not just that the infrastructure is primitive. Like the strategies are still constrained, right? So there's not a lot of funds out there with tons of capacity. They're just like, I'm just dying to do like this very complicated, exotic deal where I need derivatives and lending and so forth. On the regulatory side, so we've decided to incorporate our company formally in Malta, because we thought that they were actually thinking very progressively about regulation in the space, and they would give us access to the regulators. So we have very good conversations with the regulators out there. It's tricky when we talk about regulation and speaking to regulators. It's not like you and I can call up the SEC and be like, I want to have a chat. What are you guys thinking? Blah, blah. It's very difficult. I actually find that the most helpful sort of like short circuit to that is having a very good relationship with my bankers. Right, so our primary banking relationship was with Silvergate, and I can't recommend them highly enough. Fantastic team. I'm going to send them a fruit basket like every quarter, because they really keep me in the loop with how regulators are speaking to them and what risks they're facing. So with Malta, and we're a Malta company with a Silvergate account, we have the virtual financial license class 4, which is the highest one, which allows you a range of financial activities. But we know as we expand, right, we're going to need more specialized licensing in the US. We're fully compliant from that perspective, but I do also, to Tim and Stefan's point, welcome a day when it's going to be a little bit clearer what you need, when you need it, and how you're going to get there.
Yeah. Go ahead.
Yeah. So my second question is for Stefan. So as you mentioned, and I agree with this actually. So you mentioned actually a larger portion of trading volume of crypto actually happened on the OTC side. I think probably 60 to 70% or even higher, because that makes sense, right? Because when institutional people coming into the market, when they trade, they want to preserve their trading strategy for one. They want to remain anonymous for two, and they want to be able to trade block size liquidity. So for those 3 reasons, I think it's very reasonable to see there's a larger portion of trade happening on the OTC side. And now with what happened last year, the price drop and everything, volume dies, I think that percentage may have gone up. That's my impression. I could be wrong. But my question is, if in the market environment where basically the volume on exchanges are dying or it's just crushing, right? I know you're running basically high-frequency arbitrage strategies across exchanges, and you may have to use cross-exchange arbitrage or something like that. So how do you deal with that?
Yeah, it's a very good question. So long story short is it's actually very difficult to find capacity when the liquidity of exchanges might keep going down, right? Just to be clear. So like you said before, OTC seems like the current one of the most liquid markets in crypto right now, and I think a lot of people who may be retail investors or speculative investors trading on exchanges, they may not see that. What OTC brokerages do provide is what you said, market access for people who want to get out of the jurisdiction of the exchange they might be confined in and look at many different other exchanges, right? So it's pretty much a stopgap solution until these exchanges get more liquid, get more regulated, and have more institutional trading on them. But at this current stage, people trust relationships more than the algorithms behind the exchange, just to be clear. Does that answer your question?
Yes, perfect. Thank you.
Let's hop over there.
Yeah. So my name is Steve. I'm from Block Capital. I'm based in New York. So my question is threefold. So basically trading platform, data feed, and a custody solution. So for this discrepancy, we don't use external data feed or trading platform at this moment, because most of the trading platform out there is not satisfying us. Because I worked for Goldman for 8.5 years, I was trading, and as you mentioned, most of the trading platform is not satisfying. So seems like you guys work a lot with the trading platform or data related. My question for trading platform is there any trading platform you guys are excited with? The data part is what kind of data you guys are providing to crypto hedge funds? Because most of the data feed, I think they're off-chain, not on-chain analysis, rather than just a statistical and mathematical analysis for the crypto price movement. But what we are looking for is more like on-chain analysis, wallet movement, or those stuff. So whether you guys are providing that data. So lastly, other than Fidelity custody solution, is there any other custody solution you guys are excited about?
Okay, so the question's around trading platforms, data, and custody. So why don't we start with Tim?
So yeah, for on-chain data, Coinmetrics started 2 years ago. We run 30 plus nodes ourselves. We run them in fully redundant pairs. We run multiple data centers. We can provide full granularity. We create with our new EAP launch, we'll have 70 different metrics that we calculate ourselves. We basically have data in 3 layers of components. We have the layer 1 data, which is basically our abstractions from each of these blockchains put into a database. We have level 2, which is the aggregated cohorts, and then our level 3 data is basically aggregated analytic data on calculated values. So all of that information is available. We can track down to the wallet level, hash rates. There's quite a detailed list of data that goes on there. And then at the exchange level, as I mentioned earlier, we're aggregating multiple exchanges. We're whitelisting those through an algorithmic method by the asset. Right now we're focusing on US dollar pairs in order to be able to do that. The way that data looks for us is, again, we're collecting that in multiple redundant sets. We're bringing that into a funnel, and you can either take that from us disaggregated, so you can look at each exchange if you want to do smart order routing, or look at it from that way. And then there's aggregated reference rates, where we're basically calculating the equivalent in the FX market of closing prices, Sydney, Tokyo, New York, along those different lines. So that's the levels of data that we're currently working with from the trading platform side. Do
you want to talk about the trading platforms, Joe or Anna?
I would just say, tell Ari to call me. You guys should set it up yourselves. We can do all of that, but you can do it yourselves. And we've been working with a few institutions to be able to set that up themselves. So you can have your own 30 nodes running. You can trust your own data. You can find all that information yourself. One of the beauties of this ecosystem is that most of it is open. And so the problem is not necessarily access. It's being able to deploy, run, and manage that infrastructure. So we can help you guys with that.
And then I think the last question was around custody. So I think Fidelity is the best custodian. So I think the BitGo and Zappo. There's a number of other ones. Yeah.
They're all great, or not great.
You mentioned IBM before, and so my question is a little bit about around like project large-scale project implementations that fail or that stall. And I wondered why did this? In my own opinion, experience is mainly about the project management, it's about application, it's about use case development, whereas the contribution here at the crisis is more about the technical areas. So what, in your opinion, is the current bottleneck for the low adoption of large projects?
The question is around the adoption rate of blockchain projects. Maybe I'll go first, and then if someone wants to hop in. So I think the big thing that we saw from 2014, 15, even into 16 was really, I would say, corporate theater around blockchain. It was companies wanting to be known for doing a blockchain project, but not actually having a use case that needed solving, or trying to solve a use case that could have been solved with a traditional database with a blockchain in order to say that they're doing blockchain projects. And so I think it really comes down to what is the customer kind of demand. And so I think not surprisingly, the first wave of actual things that are being built in the custody and trade execution and data space is around customers who want to hold these digital assets, whether that be for a store of value or to kind of speculate on using them on a software platform in the future. And so I think it's really just a matter of there are a lot of projects being built in the institutional space that were not satisfying anyone's need for anything other than maybe someone who runs an innovation lab wanting to say that they're doing something. Next question.
Spot on.
Any final questions? Maybe we have time for one more.
Good to go.
Yep.
How do you think that blockchain is going to affect the payment industry, like Visa and MasterCard? How do you think that will we all have smart wallets physically in our wallets in the future?
So the question is around how blockchain will impact the payments landscape with Visa and MasterCard. I don't know if anyone wants to dive in first there.
I can dive in because I can give a pretty interesting example that's completely unrelated to what I do, but I commonly donate to things like Twitch streamers and things like that because I'm a bit of a gamer, right, and also an addict. And basically, what that means is oftentimes when I donate using PayPal or something like that, it's actually such a more seamless experience to donate with Bitcoin, and it just feels much better. And from the Twitch streamer side of things as well, they know when they receive a Bitcoin, for example, that it's not a fake donation. I don't know if that makes any sense, but long story short is that's a big problem right now with the donation community, right? So the thing about Bitcoin payments or any cryptocurrency payments is it's almost guaranteed once a certain number of confirmations come through, right? And that gives people a feeling of comfort, right? And it gives them a feeling of comfort much faster than if they had to rely on a centralized institution or payment provider to determine whether or not whose side they're on, the buyer or the seller or the donator or the Twitch streamer, right? So I don't know, it's a bit of a contrived example, but that's my experience.
Yeah, maybe I'll build on that. I think that this technology has tremendous potential, particularly when it comes to censorship-resistant payments, so payments that you otherwise would not be able to make. I think that credit card companies have a tremendous advantage in the sense that they provide credit, and a lot of these networks are not purporting to do that. And so I think that payments is not necessarily the use case that I'm most excited about, unless it's censorship-resistant payments.
Yeah, I can add a little bit of light here. So my wife was at MasterCard for 5 years, and now she's at Apple Pay, and we have very divergent views on the future of payments. And she only allows me to meet her colleagues if I don't say the word blockchain. But the fact is, credit cards in developed countries work really well, right? It's very difficult to improve upon that experience from a consumer perspective. So I do agree with Matt's take that maybe it's not, sort of the credit card payments that we're used to processing at the local coffee shop. Maybe it's something like censorship-resistant payments. Maybe it's, remittances at large scale. We haven't yet figured out a rail or use case where blockchain is clearly a better way to do that, right? So if it's not payments, I would like to see a little bit more activity around the things that credit card companies aren't doing or have no interest in doing. And that might be some of the examples that you laid out.
Yep. All right, so I think we're going to wrap up. Thanks to the panelists.